Today's episode is brought to you by Carta. Carta is the leading platform for private market deal making. With its innovative AI workflows and investment-grade data, Carta helps strategic acquirers effortlessly find, research, and engage with potential targets, all through a sleek, modern interface. Carta makes it easy to value deals intelligently and size private companies from the outside in. I love it. We use it for our pipeline development. Whether you're looking to find your next acquisition target or researching comps in your market, Carta provides all the data and automation you need to edge out the competition. Discover more, win more with Carta. Visit Carta.com to learn more. That's Carta.com. Feeling buried under due diligence documents? Exhausted from spending countless hours reviewing and double-clicking? Worried something might slip through the cracks? Imagine automating your document review process, saving time and costs. Dealroom just launched Dealroom AI, designed specifically for M&A professionals. It's like having an extra pair of eyes that never tire or miss details. Automate document analysis and focus on what really matters. No more late nights, no more missed details, just faster, smarter due diligence. Want to learn more? Head to dealroom.net and see how Dealroom AI can cut review time by up to 80%. That's dealroom.net. Because in M&A, every detail matters. Let Dealroom help you nail it every time. Hello, M&A scientists. Welcome to the M&A Science Podcast, where we learn from the best in M&A to uncover proven techniques for enterprise value creation. If you're interested in learning more about how to optimize your M&A practice or want to get involved with our community of forward-thinking M&A practitioners, visit mascience.com. It's where you can subscribe to our free weekly newsletter. If you want to keep up with us on the go, head over to LinkedIn and follow M&A Science. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Henry Ward, CEO at Carta. Carta develops software to help companies maintain their capitalization tables, which shows the company's percentage of ownership, equity dilution, and value of equity in each round of investment by founders, investors, and others. Today, we're diving into strategic perspectives on M&A and evolving landscape of corporate acquisitions. Henry, thank you for taking the time with me live here. This is Carta headquarters?
Yes. Yeah. Carta headquarters.
Carta headquarters in downtown San Francisco. Can we kick things off a little bit about your background?
Yeah. So I'm Henry Ward, co-founder, CEO at Carta. Started the company, 11 years ago now. We opened the doors for business in January 2014. We had 10 people, maybe 11 people at the time. I remember our first cap table we sold for $120. I think it was January 7th. And that month, I think we made $700 for the whole month. You know, fast forward today, we're about $400 million in revenue, about 2,000 employees around the world, doing both cap tables and fund administration for venture funds.
You're like the big deal nowadays. I got to ask you, Henry, how many times do people come up to you and they're like, "Hey, Henry, you remember me? We went to college together." And then they like probably pitch you something.
Yeah, I get a lot of emails from people from the past. You know, most of them are super sweet. They're like, you know, congratulations, or I'm a Carta user. Remember me from, you know, way back in the day. So it's super great. You know, I grew up in the tech industry, so a lot of the people I used to work with ended up working for companies or starting companies that use Carta. So it's great to meet people that I used to work with that are now Carta customers.
So that's what I said when I first met you. Like, I got my Henry story where I ran into you back in like 2013 at one of these startup conferences, and it was just Henry in a booth with eShares, but you were just very like casual, friendly, open, and just got walking through the model and vision you had. And fast forward, you know, about 11 years later, here's what this organization turned into. So it's just really cool to see that growth. And not to turn this into a big commercial for Carta, but we're active customers. I think the one thing I've been absolutely impressed with is we're a bootstrap business. So I think there's like two tails to compare because you've obviously raised a lot of institutional capital. We've continued to bootstrap along. But we're a company that has a SARS set up, which every employee in our company gets to participate. And I don't think we would have been able to enable this without Carta. Because it was like, hey, you could sort of do it with some key leadership folks and do it on a basic spreadsheet. But then when you roll it out with about 50 employees, that gets pretty complicated. There's a lot of administrative overhead that we probably otherwise wouldn't have invested in. So it's pretty cool because when I first met you, I didn't understand it. I was like, cap tables aren't that complicated because it's just me and the company. And then, over time, it's been really interesting to see what actual power of that platform has done.
Yeah, it's pretty amazing to think about, in the 1800s, how you got paid was very manual. And then, of course, the big car manufacturers, Ford, GM, right? They had to create a consistent way to pay people wages, right? And that really unlocked the ability to have huge huge workforces in the economy. And I think our view is, can you make equity as simple and easy as payroll? And if you could, would that just unlock a new form of compensation that couldn't exist before because there was no system to support it? And if we can enable that and sort of, as we describe it, move the world from a payroll economy or payroll labor era where people rent time for money to an ownership era, if we can catalyze that transition, that's our contribution to the trajectory of history.
I get it now. Finally, after 11 years, I figured out your business model. Hey, okay, that's enough for the Carta plug, but we're really extremely happy customers, and there's a lot more I could say about that, which we'll probably get into some other aspects of the business, but let's talk M&A. That's what we're here for. You've done a number of deals since starting this company, and I love to have this conversation because founder, CEO of the business, you've done about 9, 10 acquisitions?
Yeah, I think 10. Yep, I think that's right.
Give me the story. Like, what prompted the first acquisition? What drives you doing deals?
I'll give the first acquisition that didn't work out or that we didn't buy. There was a 49A firm that, in the circa 2014-15, we started to get into the 49A business. You had this cap table product, but really what customers wanted was 49As. And we didn't know how to do 49As. So we partnered with a valuations firm out of Utah that did valuations, and we became distribution for them. And I think we would sell 49As, and we'd keep 20% of the revenue, and they'd get the other 80% for doing it. And we just started working with this firm, and we started growing that business pretty dramatically. Like, we sold a ton of 49As. That firm, when we started working with them, was, I think, 3 people, and then they grew to 20 or 25 people in Utah in less than a year. And we were just selling a ton of 49As. And we were building all the infrastructure to support this team to do these 49As. And I realized that we had the single point of failure. The most important product that we had at the time. People actually cared more about the 49A than the cap table back then. And we had the single point of failure where if this 49A firm that we partnered with, something happened to them, the founders wanted to go a different direction, whatever it was, we would lose our ability to produce our mission critical product. And so I approached them and offered to buy them. And I remember, it sounds so quaint now. I think the business was $1 million in revenue or something. They wanted $5 million. We were willing to offer $2 million or something like that, maybe $2.5 million. And we just couldn't get there on valuation, and we ended up not buying it. And in hindsight, I'm so glad it didn't work out because we ended up building our own core competency. We would have given away 20% of the company at that point, or 15% of the company at that point for this services business. We ended up building it ourselves, and that became. Now we do 30,000 49As a year. We're the biggest 49A provider in the country. It became the core flagship product for most of our cap table users. And the reason I highlight that story is, even if deals don't consummate, there's often something that comes out of it that's incredibly valuable just because of the learning that happened with that process. And I think that's one of these classic examples where you did the partnership, you figured out the partnership, you couldn't get the deal done, and then you figured out another path. Outside of that, we ended up starting to do a lot of deals over, I would say, circa 2016 to 2022. I think we did all 9 or 10 in that. And we've done everything from product tuck-ins to Acquihires to a book of business buys, right? Every M&A deal, happy to dive into any or all of them. Any of these M&A deals have a specific thesis or problem that you're trying to solve. And I think we've done, I can't think of a problem we haven't tried to solve so far with M&A. That's been a huge tool for us.
Let's get some examples. Let's walk through some, like, I'm just curious, like what's early deals? I think even for like a younger organization like us, where we haven't done any M&A, I'm just curious of what are some big lessons learned doing those first deals. Maybe we can just talk through some of those.
Yeah. So maybe the two I'll talk through. One was a book of business buy, and one was Acquihire, because I think those are super common to do. And then we can also talk about the third flavor, which is usually product tuck-in or cross-sell products. So one of the best deals we did was we bought from Silicon Valley Bank their 409A business. So in the early days, our biggest competitor for 409A was Silicon Valley Bank. We had a lot of long tail competitors, but the giant in the room was always, the gorilla in the room was always Silicon Valley Bank. And we were constantly competing with them. And we ended up getting to the right people at Silicon Valley Bank above the leader. So they had a leader who was running the 409A analytics team that we used to deal with, and they hated us. We competed, and they really hated us. We were able to get to the COO level at Silicon Valley Bank and convince them that they should get rid of the 409A business because it wasn't making money for them, and that if they sold us the business, we would then partner with them on selling Silicon Valley Bank commercial bank accounts to our startups. And so it was a two-way swap. And it was one of these really classic examples where if you had asked the team, they never would have sold, right? We were the enemy. They never would have sold. You had to get high enough, and this is an example of buying a business from a larger strategic, where you had to get high enough that they didn't care about the specific business line that you were trying to buy, but they cared about something bigger, and that we could solve their bigger problem, which is really what they wanted was more startup exposure, which we had. In exchange for that, they would give us the 409A business. So we ended up striking that deal on I think a Sunday night after 5 days or a week, I think, of negotiations. It went really fast once we got to the right people and convinced them of the right messaging. What I would say is that's also a really good example of what I'd call sort of a semi-hostile takeover, right? Where I remember when they invited me in to meet the team at Silicon Valley Bank to announce this acquisition. It was a small one. It was 40 or 50 people. But I walked into this room with all these valuation analysts that had spent the last 4 years just, competing with Carta at the time, eShares, and just hated us, like absolutely hated us. And I walked in and it was just daggers in their eyes. They were, and it was actually really hard when we gave them all offers. We brought them to our office. We tried our best to retain them. A lot of them, just wouldn't even entertain the idea of working for us. We had to convince, I think we had maybe 2/3 of them were willing to stick with us. The other third just jettisoned and said, we're never working for Carta. And then it was a lot of work to try to keep those 2/3 and convert them over. But we did. And it was actually one of our most successful acquisitions because it brought us the entire Silicon Valley Bank book of business, which at the time was, I think, $4 or $5 million in revenue, which for us back then was a lot. It got us incredible supplier capacity because we had all of these experts. It was almost an acquihire in that sense. And then third, it really solidified us as the brand name because before us, Silicon Valley Bank was the brand name. And by buying the Silicon Valley Bank book, we became the brand name. And I think that was the inflection point for us.
Wow. Did you expect that churn going into the deal?
We didn't know we didn't have an expectation of how many would churn, but we knew that there was going to be high risk, and it was on us to try to keep people and ask them to give us a chance of working at Carta.
I like this deal because this is essentially a carve out of a large strategic. How did you get in?
I had developed a relationship with the COO at the time, and there were teams underneath me, my strategy and Corp Dev team, that were working directly with them, trying to figure out a thesis and a case and kind of work around the edges. And then when they had enough sort of context, of figuring out what Silicon Valley Bank would care about, what they wouldn't care about, was it actionable? And they do this all by just talking to people around the carve out, around the business that we wanted to acquire. That when they had enough of that, I went to the COO and I got time with him, and I basically made the case for it.
I mean, does this like initiate with a cold outreach of, hey, I just got some ideas I want to chat with you about, or is it a little bit finding ways to get in through introductions, or what would that look like?
I had met the COO. I don't remember exactly how. I think we had gotten connected as just sort of a person to know in the industry, a year earlier, which is like, hey, if we ever get a chance to work together, somebody had connected us in a sort of random way.
Yeah.
So I'd at least had him in the Rolodex, so that when I did reach out, it wasn't completely cold. He knew I was. I had met him before, but it very much was a, hey, would love to. I know my team is working with your team on some ideas. Can I stop by your office for 30 minutes and pitch you my ideas?
I think it's a pretty collaborative effort. You have your in-house team, and you essentially derived a business case where you obviously want the book of business that they have, and kind of weather down a competitor. But then also, that they want to create more bank accounts. They want to get into the startup ecosystem and generate more business there. And that's how you build that case of a win-win. Then you essentially just took it right there to present it.
Yeah. The hardest part about private M&A is actionability. It's how do you create action? Because there's so much inertia around not doing anything. And so just getting people to engage on actionability, and I can give you so many, for every deal we have done, I probably worked on 5 to 7 deals that we wanted to do that we couldn't make actionable. And so actionability is the number one challenge in private M&A. And then to create actionability, you really have to figure out on the other side, who are the decision makers, like who are the stakeholders in this, figure out what's important to them and build the case for them. Nobody will build the case for themselves on actionability. You have to build it for them. If they're building the case for actionability on their own, they're effectively putting the asset up for sale, and they might as well just get their bankers involved. But if you're hunting, if you are going out to try to take an asset, you actually have to build the case for them. They're not going to do it.
This is being proactive. We've been talking a lot about this internally of buyer-led M&A. Like, what does that mean? And I think this defines it, that you have a strategy for growth. You're looking at M&A as a tool to achieve that. And this is when you're really proactive and driving that movement. These is out of every deal, the 5 to 7 that don't get done. What are the blockers that keep you from getting those done?
Yeah. So especially in private, especially in venture, you would like to think that people are financially rational. Almost never that's true. For example, of an SVB, they don't care about $5 million in revenue or getting some more bank accounts. Like as a firm, what you have to map, for example, is will the COO look good in front of the CEO if he does this deal, right? How will the chief of staff that's backing it, if in the room, if they do the deal, will the chief of staff get a promotion, or a positive review in his performance review or not, right? Those are all the things that matter. It's all very person dependent. And you see it even if you're doing, just trying to buy a company. The biggest blocker to buying a company is the CEO. Does the CEO want to sell the company or not? If they don't, you can give them all the financial analysis and mathematics and prove to them that you're giving them not just fair value, but better than fair value. But if they don't want to sell, there's no actionability. And so how do you convince, oftentimes by definition, irrational founders, right? Because venture-backed founders are irrational. How do you convince irrational founders to be rational? and sell something, sell an asset that they don't want to sell.
Got to convince them to sell.
That's the hardest job is creating the actionability on it.
What's the playbook to convince someone to sell their business?
Yeah, it depends on it's very idiosyncratic to the business. So for example, product tuck-ins would be, acquihires tend to be easier because they're failing anyway. So you don't really have to convince them. They're already being sold. So in general, acquihires are being sold anyway. So those are pretty easy. Carve-outs, you can do things like make the business case, et cetera, et cetera. When you're trying to buy a company that's got a product that you want, if it's doing well, by definition, it's a very hard thing to buy because it's doing well. And nobody wants to buy the product that's not doing well, which is the old adage that, companies are bought, not sold. So if the company is going out for sale, especially early stage, it tends to be harder to generate interest. So you have to go find the target and say, like, I want to buy this. And it depends a lot on the founder. One of the most common playbooks on these product, smaller, when I call smaller, like sort of, Series A, B, C type, maybe A, B type companies that have, product market fit but have not really scaled is to try to make the case with the founder that their vision of building a product that many, many people will use will be more likely to happen and come faster if they join you than not. And that's usually this combination of, hey, we'll have sales distribution, right? One of your biggest challenges, you have an amazing product, but one of your challenges is, how do I sell it more? How do I get it to market? And we have, in my case, as an example, we have 30,000 startups and 2,500 venture funds on the platform that if we had your product, we could sell it to them. Another one is, sometimes these founders, they have a great product, but they're just struggling with some of the scale and operating. They hate G&A, they hate all the parts. They love building product, but they hate company building, which tend to be the best founders to buy, or best founders to work with and buy their companies. And so you say, hey, you can come here and you can focus on product, and I'll take everything else out of your hands. I'll do sales for you, do HR, I'll do legal, I'll do compliance. All you have to do is just build a product people love, and I will take care of everything else for you. Sometimes it's convincing founders, hey, it's you got a great product, it's going to grow, but the question is, like, what do you want to do? Do you think you can make this an IPO-able company? A lot of products not. These are niche products. They scale out at a certain time. But, why don't you come be an executive at our company, right? Not only if you came here would you own this product, but I'm going to give you a whole set of products along with it, and you will own a much bigger piece of Carta, not just the stuff that we purchase, but everything else. And I'm making you a C-level or whatever senior executive at Carta. And for many founders, that's appealing to them, is they don't necessarily want to do the 5 to 10 year lonely journey, but joining a bigger team. So it all depends on the founder and really understanding what the founder cares about.
So see if I got this. One, this is how to convince people to sell their business. One, look for the underlying drivers, because there could be things that are not so obvious, right? Like the promotion, things like that. You had an example. There's a theme around helping them realize their vision faster, because however those elements are to get there. Fix what they hate. If there's some of the operational things they really don't want to do, those are things that you're good at or already matured on. So you can position that as part of the case, and then being part of a greater team and sort of what the bigger, broader team could achieve. There's a financial case too, which you mentioned, which I want to dig into a little bit. So I get approached every month by about 5 to 7 VCPE. And in my head, I'm like, we're still bootstrapped. And when I wanted the money, you didn't want to give me the money. Now we don't need the money. Now you want to give me the money. And it's like, well, I look at the equity and it's like every year we're growing 60, 70%. And, do the math. It's like pretty financially good. I just got to stick to this and wait for the right time. I don't want to hold on too long, right? How do you sort of build that financial case, given that you might be dealing with somebody in that case, or they just got a different situation, venture backed, and they're still in that strong position? How do you sort of walk through or have that conversation to get them sort of steering? Because right off the bat, I'm a little bit hard-headed. Like, I'm in the best scenario. I got freedom. I don't have a board.
Yeah.
How do you sort of counter that?
Yeah. So I think a lot of people start with the economics first, and the seller always wants to start with the economics first, in part because, the sellers want to start with the economics first, in part because many times they get these inbound requests, including from me, and they're just saying, well, how much am I worth? How much can I get for it? Right? They're price optimizing for it. And that's why I think, at least from a CEO perspective, like a CEO to CEO conversation, my style is I really push out the financial conversation, because what I say to them is I say, if you want to come to Carta and be a part of the Carta portfolio and team, if you only do it because I pay the highest price, I'm not sure that's the right fit. Right? I want you to do it because you want to come. And then if that is true, then we'll figure out if the economics works. But it really starts with, what do you want to do with the company? Do you see a roadmap or a path to join Carta, whether today or in the future? And if that's true, then let's figure out the economics and how that fits. But it really starts, for me, in my conversations with the founders, what do you want to do with your career, your life, your company? And if Carta can help you with that. Oftentimes the answer is no. I want to do it my own, or I don't see Carta's not the place I want to be, and I don't even get into financials at that point. I let it go. So it only works if we have founder fit, because especially in these earlier companies, half the value of the company is just the founder, right? The company doesn't exist without the founder. So you really have to have the founder buy-in. So assuming you get past that checkpoint and they're like, oh, okay, I'm interested. I usually say, okay, well, let us do a little bit of work. Would you be willing to open up a summary data room where we can do some rough math? They'll usually push back and say, no, can't you just give me a number? And we're like, well, it's hard to give a number, without the data. And you'll go back and forth a little bit, but hopefully you'll get enough data that we can at least get a ballpark range. Almost the number one place deals fall is they're just not founder alignment. The number two is, of course, on pricing. And so what happens is I just, make it up. This actually isn't too far off some conversations we had in the last year, where I was talking to a founder. They're $5 million in revenue or so, and they want $100 million for the company, something like that. And nothing trades at 20x today or last year. Right. And I said, where do you get the 100 million? And I said, well, we see a path to 10, and so 10x times 10 is 100. And so, if we can see a path to 10, you should pay us for the 10 times 10, et cetera. And a lot of the times that's just sort of an education process. So what we do is when we value the company, we show our math. We show everything. And we take the comps that we use, the public market comps, and we'll just show it to the founder, and I'll walk them through. This is how we think about valuing you, and arguably this is the science of M&A, the science of valuation, which is if you just took the comps, normalize it, create a median, quartile, I'm making the numbers up, but let's say it says you are 6x revenue, and what we'll explain is your growth rate is encompassed in the marks, right? So if you look at all the public company marks, Salesforce, Rubrik, like everything else, like they're all growing 20 to 40%. In this hypothetical example, you're growing 20 to 40%. So your growth rate is captured in that multiple. And so you don't get forward credit. If you were growing 100%, the comps don't make sense because all of these are growing 20 to 40%. And then we'd have to do a different model, right? We'd have to do an NTM model or kind of forecast it 3 to 5 years out, like all this kind of stuff. But in your case, you can just see the math in this example. And let's say if you take the median quartile or something, you're 6x. And so that in that example, you're 6x times 5, so you're 30 million. And so what I'll say is like any third party would value you this way, right? You can argue over which the comps are. Should you take median, quartile, top quartile, like you can, but that moves it, from 6x to 7x, right? Or 6.8x, something like that. It doesn't move you to 10x times 10 million. So you're somewhere in that $30 to $40 million range. no matter who does it, right? We can show the comp set. All we're doing is tweaking around the edges. And so the valuation is set. What's different is once you set the kind of scientific valuation, the art comes into, do we pay a premium for you because one, scarcity value, let's say. Let's say you're the only asset in this space. You should push back and say, Carta, the math says 6.5x, but we're the only asset in the space, so you should pay a premium off that. Another version is I might say, the math says 6.5x, but I should actually pay you less because all these comps are at scale. They're growing 20% at $1 billion in revenue. You're growing 20% at $5 million, right? So it's not comparable either. So I can push it down. But everything then becomes a conversation around the fair value is 6.5x, and then we talk about why you'd move it up. Scarcity value. The founder's amazing. They have strategic value to the customers that they have. Whatever it is that makes a premium on top of that. And of course, I'll take the other side, which is all the things that I would take a discount on. And why that's really important is then you become very clear about what you're trying to buy, and the founder understands what you care about. And you might say, look, we don't see a premium on this one. We think it's fair value. Or you might say, you're right. We should pay a premium for you. And what I coach founders on is, who are thinking about selling is, there's a difference between trying to sell for the optimal price or a fair price. And if you actually are bought into a vision, get comfortable with selling for a fair price, because otherwise you spend all your time trying to optimize, and it doesn't matter that much, right? Whether you sell it for 6.5x or 7.5x, 5 to 10 years from now won't matter. All that will matter is if you sold or not. And that's the thing to try to figure out.
Is there a view of, hey, we're growing well, like our business sits in the 60, 70%, like we've been fortunate, it's going well, that a strategic approaches us, which happens. And then it's like, well, if I just keep waiting, this is a pretty significant difference in how you value it today versus 1 year, 2 years later. Do you get a little bit of that sometimes where it's like, well, we're doing good. I get how you value it today, but what if we just wait a year? Then you're going to have to, as long as things are on the up and up and you have that level of confidence.
Yeah. Always. And that's really the challenge. So for example,
is that like my sort of counter of like why you should pay the premium? Because it's like, look, we're pretty confident we're going to hit this year. So why don't you value us to what we think you'd be valued next year?
100%. And so in this example, you might say the comps are comparable. If you're going 60 to 80%, you could change the comps, right? And say that you have to comp against 60 or 80% growing companies. Hard to find those in the public markets today. So you have to do like a NTM valuation and kind of look forward 100%. The thing I would say about the thing that actually makes those 60 to 80% arguments hard is even if you could agree on the value, which is fine, the challenge for the founder of the acquired company or potentially acquired company is, of all things, so let's say we're growing 20% as an example, because we're larger, we're at scale.
Yes.
But your company is growing 60%. All things being equal, everything being equal, your stock is appreciating at 60%. Our stock is appreciating at 20%. And so you're taking away, to your point, from your upside by doing a stock swap with us. You're effectively trading in your stock for our stock. You're trading in your stock that's appreciating at 60% for our stock that's appreciating at 20%. If you're growing at 20%, it's actually even, right? It's totally fine.
It wouldn't be a big deal.
It wouldn't be a big deal. Yeah, just do it, right? But if you're growing at 60%, it's not just paying the premium, but also you're decelerating the value of your stock. And so that's why high growth companies are incredibly hard to buy, right? You have to buy these companies with sort of unreasonable premiums, right? And that goes to, companies, dividing companies up into companies that you'd pay a good price for and companies that you'd pay any price for. And the super high growth companies are the ones you'd pay any price for.
So you have to pay a premium.
Absolutely, even if you could get it done on a premium, because how far ahead do you pay the premium for, right? Is it 1 year, 2 years, 3 years? If this thing's compounding at 80% and you really feel like it's got the ability to continue, it's very hard to pay 5-10 year premium. This is like the WhatsApp deal, right? even Instagram, right? They could see and they paid way ahead. And then looking back, they didn't pay ahead enough, right? They could have charged a lot more.
So that's what you got to ultimately, it comes down to. It's like if you're willing to do that. But I feel like there's just that counter argument on both sides of how you would, and I guess that's fundamentally the approach to solve that valuation gap. Is there any tools or anything else you use? A lot of folks lean on earnouts. Do you sort of look at that way of like, well, okay, if you're going to look at that, 60% growth being continuous, why don't we throw an earnout there and hold you some level of accountability to get that current valuation you're looking for and help bridge that spread?
Yeah, I'm personally not a huge fan of earnouts. They can be a useful tool to kind of close the gap if you're like really close and but you're not quite covering the bid ask, and so you throw in an earnout to make everybody on both sides feel a little bit more comfortable. In practice, earnouts almost always get paid regardless if you meet the numbers or not. So I'm not a huge fan of earnouts for that reason, but also it does potentially create conflicts of interest. So, for example, let's say you buy a company and you have an earnout on revenue, but you realize after 6 months or a year of integration, you don't care about revenue. You care about ubiquity. You care about usage. So you're like, let's discount this product as a loss leader for our other products and put it in the market. Well, now you have this earnout
conflict.
Yeah, you now have a conflict because the people in charge are trying
Somebody's
to get revenue.
Somebody's going to sue somebody at that point.
Exactly, and then you got to renegotiate the terms, and so it just ideally what you really want is that founder that's just bought in to the vision and wants to support the company.
So be a little bit upfront and just pay that value out, especially if you're doing some of it as a equity swap.
Yeah, I would say in general, if you making up numbers, if you're willing to pay $100 million for a company because you think it's got a lot of potential, and they want it 120, and you're like, well, I'll do a $20 million earnout. I would just say, just pay the 120,
yeah.
And don't make them take the risk. Make them join you.
And when we reference multipliers, are you looking at last year's number, trailing 12, or run rate?
It just depends on the growth rate of the company and what the right comp set is. So if for example, the company is, an ARR-based company growing, 20 to 40%, it's very easy to get public comps on that. If the company is growing 100%, for example, you then need to do forward earnings because you need to give them credit for forward progress that isn't reflected in the comps in public markets.
But if you're saying, hey, 10x revenue, are you referencing primarily last year's revenue, trailing 12, or run rate? Because I feel like I'm just, sometimes I talk to too many bankers and everything's like run rate, whatever's a bigger number.
Yeah, it's super, it's very conflated and convoluted how they do that. In general, when we think about it, it's for us as a B2B SaaS business, we usually think of multiple on current ARR. Sometimes we take it in private companies. If we're looking at bigger companies that have transitioned to really more of a revenue, when I'm talking revenue, I mean GAAP revenue, not ARR or bookings. We'll look at GAAP revenue, and it's usually on a NTM basis.
We'll continue that with your CFO and get the.
Yeah.
So the big takeaways, there's got to be ultimately this business case or vision of better together that you're both locked in and aligned on, or just ultimately like this is really the right path forward. Then get into the pricing, and that's when we can get into those details and how do you overcome the bid spread there if there is one.
Yeah. So absolutely, it's for us. It's typically kind of two steps. One is establish the conviction with the founder that we should work together, and that's my job. And then the second is to cross the spread on the economics, and ultimately that will be my job. But usually that's done with my CFO and Charlie and Davis, who runs Corp Dev, and they usually do most of the financial negotiations so that I stay out of it unless I need to be in it.
Going back to strategy, where you kind of use this initial example of acquiring the book of business. Acquihires are interesting. You've done some acquihires.
Yeah.
What's the premise around that? Because I always feel like can't you just recruit the talent? And I don't know. You hear companies are spending like, what is it, like $1 million per engineer? Like, how do you sort of view and like, why would you do an acquihire?
Yeah. So our acquihire was, well, I should say our big acquihire, our biggest acquihire was about 60 people, almost 70 people in Waterloo. And it was actually a company called Kik, which was a consumer chat app for teens that couldn't quite hit the inflection point and was starting to run out of money and end up having to sell the company pretty quickly. We got hold of it because it was also one of our investors was also an investor in that company, so we got early access, and they basically were willing to go with whoever could move quickly enough. And this is an example where, being small, nimble at the time, I think we were only a few 100 people, 500 people, and we had an inside path to the CEO. I had met the CEO previously at conferences. So we immediately could start engaging, and once we got the call that this company was up for sale and the team was up for sale, we all jumped on a plane to Waterloo and started interviewing and getting wrapping our arms around it. I think those types of deals where you have inside advantage because you know the team, you know the investors, you know the founder, it's a forced sale are powerful. When these acquihires have more time to shop, it's very hard to compete with the big firms, the Googles, the Shopifys, right? They are much more likely to pay for talent. Our thing was we basically gave them enough money to sort of clear a little bit of the preference stack, pay off their liabilities, and then promise that we'd give everybody great jobs, and which is what we did. But these other firms like that will pay them $1 million a year per engineer instead of recruiting them. Those I think are out of sight for most venture-backed companies. Those are really like a Google, Facebook playbook.
That was really for the engineering talent, ultimately.
Yeah.
To really increase that. And then when you look at the product, what was the word you had?
Product tuck-ins.
Product tuck-ins.
Yeah.
Product tuck-ins. Just accelerating your roadmap.
Yeah, that's right. And I think, when we think about product tuck-ins, there's maybe two ways to think about it. So one is stuff you think of that you go out and hunt, and then stuff you don't think of that's opportunistic. And so, for example, a product tuck-in example might be we want to go build this product, but we don't have the time, we don't have the engineering resources. We don't. We want to get this to market faster. Like it's our idea. We know we want to do this. And M&A is just a way to sort of accelerate that to see if we can find a product that fits what we want to do and put it into the portfolio. That's probably the right and best way to run a Corp Dev strategy is to go find the things that you want to do. And the Corp Dev team is effectively an extension of the R&D team, and they are just an accelerant of that. The other side that we spend a lot of time thinking about is opportunistic stuff, which is we didn't think of something. We don't know much about the space. We don't know much about this product. But boy, we come across a company that we're just canvassing, and we come across this company and like, wow, they're doing something really interesting we hadn't thought about. And then you start talking to this company and you have to form a thesis after. So maybe another way of thinking about it is like there's acquisitions where you have this thesis a priori that you formed beforehand, and there's acquisitions that you have the thesis afterwards, after you meet the company. And sometimes those can be, I think most conventional Corp Dev or M&A science is, don't do that. That's like rationalizing
that's what
an
gets you in
acquisition.
trouble.
That's what gets you in trouble.
trouble.
That's right. And I think our perspective is we find those things incredibly fascinating. Like we love looking at those because it's sort of this thesis. It's like I think it was Andrew Grove has said, no matter how smart your company is, people are smarter on the outside. There's more smart people who don't work for you. And just like, hey, other people might have come up with, better products than we have in certain segments. Some founders may have better ideas than we've had, and we don't have to generate all the ideas in this space.
So we have this approach of accelerating the strategy, which is where you may find products that would fit in your roadmap or what you're trying to ultimately achieve. And then you've got the stuff that doesn't come. We talked a little bit about this, but this is like bounded versus unbounded. Is that the kind of similar framing here?
Yeah.
Where if it's really aligned with the strategy, it's kind of pretty bounded in that effort versus like here's stuff out of it, but then all of a sudden you're kind of rationalizing why you would do the deal.
Yeah. So I think there's another way to segment ideas or companies or targets. So one is sort of the bounded targets where you're like, look, we can buy this asset and it gives us a path to 100 million in revenue, and we just know that that's the bounds of this. It's got limited runway, and then there's another type of asset which is this unbounded, which is this could really inflect and be a non-linear curve for us. And what's interesting about both of those they're both good strategies. One is I would call a private equity strategy, where it's a bounded target and entry price matters. So you would only pay a good price for it. You wouldn't tend to overpay.
Value.
Yeah.
Sort of looking for a good deal.
That's right. At least fair price, if not value price. And then these unbounded targets, you actually run. You think of them more like you're doing a venture portfolio, right? If you're doing bounded targets, so these are singles, right? You wanna be very disciplined on pricing and how you run these things, and making sure you're successful on them. Like writing one of those to zero is very painful. If you look at these unbounded targets, you run them more like a venture portfolio. You will expect several of these will go to zero in the hopes that one will be, in the famous, Facebook example, Instagram, right? You only need one Instagram to wipe out every other bad M&A decision from the past. And I think for us, we've been more of a bounded model. We've been very particular about the types of deals that we do. We're swinging for singles and doubles in general on Corp Dev, rather than trying to hit home runs. That being said, I think where this opportunistic side of M&A is, and why I'm a believer in it, is if we have a home run idea, we're just going to go do it. The problem is it's hard to come up with home run ideas. And if somebody else has a home run idea and we can see it, and more importantly, that we think if we can bring it under the Carta umbrella and make an idea that's a strong double or triple and make it a home run, then we should absolutely go after it. And that's our unbounded thesis.
But these are stuff that really would be out of scope of what you've already defined as a strategy. That would be unbounded. But it still looks good. It still at least fits the realm of your ecosystem, and you could see some synergies there.
Yeah. A lot of this stuff you may not see, most people may not see as unbounded. And part of the job of the acquirer is to see these things that other people may not see as unbounded, but you can see how it becomes unbounded.
That's what I want to dig into, because I've done a lot of these conversations. You talk to a corp dev person, there is a discipline around being bounded to the strategy and then using that to proactively find the right targets. That's your good corporate development practice. What you're saying doesn't counter it, but it says, hey, there is unbounded things and you do rationalize it, but you sort of adjust the risk accordingly, and it's not way out of bounds. It is like maybe a little further from the core, but not too far out, and it's going in a totally different segment. There's still some synergies there. Does that sound right?
Yeah. So I would say maybe, again, in sort of like this bounded, unbounded PE versus venture portfolio, there's also, to your point, Kison, here's our strategy. Here's the missing pieces of the puzzle. Go find the pieces of the puzzle and put them in, right? And so this is like, we're missing a product to do this. Go find a product that does that. We're missing, infrastructure to do this. Like, go find that. And so there's a very clear thesis around it. And then there's this, and that's a disciplined, process-driven approach. Then there's this other version where I'll talk to Davis and I'll say, go find me your craziest ideas out there. Just no limits, right? Just the craziest things that you think are interesting. Let's go talk to some of these founders and see what they're working on. And arguably, 19 of the 20 conversations go nowhere. But you might get that 1 in 20 that, there's something I hadn't thought of here. And I would say we learn a ton about founders, markets, all of these things by doing these conversations. There was one company, and I'm very interested in. Never occurred to us that we would ever go into the space, but we did this. Let's just just bring me your craziest ideas. And I met this company, and I'm enamored with it, and I think it's incredible. But I never would have thought of it myself. It never would have been in the roadmap.
When you do that, and all of a sudden you're rationalizing why you should do this deal, would you consider your strategy changing then at that point to include doing this deal?
Yeah, I think so. I think the strategy evolves. So it's not enough to just say, well, I love this company, we should buy it. Then we just be investors. What happens is when you see something that you hadn't seen before and you're like, wow, if we had this asset and we combined it with Carta, here's like the 7 things we've unlocked that it never occurred to me we could have unlocked, right? And then suddenly you're like, oh, why hadn't I? What's wrong with the strategy that I hadn't thought of that a priori? And so you back into what's missing in the strategy that it didn't cover this thing that now that I can tangibly see it unlocks this set of opportunities that we didn't have before. And then you refine your strategy off of that. Because a good strategy, if the intuition is, hey, the tactics of putting these two companies together is incredibly powerful, but the strategy doesn't fit, that must be something's wrong with the strategy. And then you refine the strategy.
Do you have an example of one of these unbounded deals you've done?
I would say we have not successfully done an unbounded deal. The example that I'm thinking of, unfortunately, I can't share, but I'll share one. I'll share a deal that we did that we thought had potential to be unbounded. It didn't work, and it was we bought actually a couple of former employees of Carta left and went through YC and did a tax tool and their thesis was a great one, which was TurboTax. TurboTax is a great product, very hard to compete with. Nobody should try to take on TurboTax. That being said, if you are an employee that gets equity compensation, you can't really use TurboTax. So there's this underserved population of tech employees that need to all go to CPAs because they have tech stock and they can't use TurboTax. And they said, we're going to build TurboTax, but for employees of tech companies. So it's TurboTax with equity. Great thesis. They built a good product and started, getting some users. It's a great team, great founders. They're Carta employees. There used to be, and so it was one of these where we paid a premium to bring them back to Carta with their product. And our thesis was, if this works, we have about 1.5 million employees on Carta with stock now. We could just cross-sell them TurboTax for equity, or this company was called Year End, and we ended up calling it Carta Tax for employees. And so that was like an example of an unbounded thesis, right? Low chance of working. We're not consumer people, right? Competing in taxes is really hard, like low probability of working. But if it worked, to be the TurboTax for all tech employees, pretty big market.
But that one, you did the deal, but it didn't hit that chord?
It didn't work. We couldn't figure out the product plus distribution. And tax is a very hard one because it's just an annual thing. And so you kind of build up. And if you miss the window for that year, like you're just sort of sitting around, building and hoping the next year goes better. So it's a very hard market to get into. And I think also, I think the team was great. The product was great. I think there's a failure as the acquirer, where we did not understand. We tried. It wasn't for lack of effort. We just did not understand how to do consumer go-to-market. We are a true B2B SaaS business. I mean, we sell to companies, and to sell to consumers is a completely different motion. And it really informed us because now I wouldn't say we've eliminated consumer products from our M&A perspective, but we have highly deprioritized it. We have basically said, look, we are not consumer people. We are B2B. And so any consumer apps, we're not really interested in. We're just looking at B2B apps.
So when you and validated the thesis here, what do you do then? Is it wind down the business, sell it?
We ended up, this was a great one for us. We ended up winding down the consumer version of the product, but then we were able to learn from that on the B2B side because of our relationships with our customers, that we then turned it into a tax advisory as well as a QSBS tax product for the companies. So again, it's one of these things where the initial thesis didn't hold true, but we learned so much from the experience. Now our QSBS tax product that we give to employees through the company, which has extreme product market fit, came after all the learnings with that team. And that now is our fastest growing product that we sell to startups is QSBS.
Turn a loss into a win.
Yep.
What about capital allocation as a whole? I'm thinking about the organization. You're funding a lot of strong organic growth. All the departments want their budget. And then you're talking through all these inorganic, aren't cheap. How do you sort of plan like, hey, this year we're going to put 20% towards doing some M&A activity, or is it more ad hoc as these opportunities come up? You get capital on demand when you need it, and that's how you play off of it. How do you think through that?
Yeah, so
I guess I wonder more importantly is like how that evolved, because even like a smaller company like us, we're pretty stringent about it, but now you got $4 million revenue, so it must have evolved over time.
Yeah, so I would say we did a good job. I think circa 2016 to 2022. We did 2 companies in London. We did a company in India in 1 year in 2022, and did 7 other acquisitions before that in the previous 5 years. So we'd been pretty active. I would say in the last 2 to 3 years we have not been as active. In part digesting the acquisitions we did in 2021, but also just it's been a difficult market to do deals. It's been super volatile. Valuations are all over the place. I would say the biggest, we are almost profitable. We'll be profitable this year or at the end of the year. We got about $500 million on the balance sheet. So we're super, I would say one of the biggest criticisms of me as CEO is I haven't been more active in M&A. We haven't deployed more capital in this. And so this is very much a focus for me over the next 18 months is how do you think about deploying that capital? Typically when you think about capital allocation, if you're becoming profitable as we are, and you got 500 on the balance sheet, let's say we can use most of it. You can use almost 500 million on it. You'd like to see most of these deals get done somewhere in the kind of call it 30 to 40% cash, 60, 70% stock range. And so if that's, it depends. Some will be 20%, some will be more. But if you sort of think kind of 30% on average in cash, 30 to 40%, you have roughly $1.5 billion of buying power. And so we can go buy $1.5 billion worth of stuff. And so the question becomes then, if you have $1.5 billion of buying power, do you buy, in one extreme, $1,500 million companies, or 2, $750 million company, one $1 billion and one $500 million company, which I would consider not tuck-ins, but what we would call transformative M&A. And so one of the things we think through is like, do we want transformative M&A, or do we want, smaller ticket sizes? And how do we build that portfolio?
Which is a whole other exercise, and would be a good opportunity to get a sequel to the conversation. There's got to be a lot to really factor in and think through, and that's probably is when you're digging back into your strategy and just starting to think about like roughly what it's going to take to execute on some of those potential moves. I mean, do you start looking at your pipeline at that point and start saying, well, roughly how would we start thinking about allocating, or roughly like what are we looking to do this next year for deals, and get a sense of how much we'd likely allocate?
Yeah, 100%. So we have a list of companies and targets that we are interested in. We, without core data, we have a sense of value of these companies. And so we can just map it out and see, how much buying power do we have of these companies? Which ones could we buy? If we bought, these 3, does that preclude a 4th? And so part of the challenge is, which companies are actionable? Which companies do you buy first? If you buy company A, does that mean you can no longer buy company B? but you don't want to, company A might be actionable, but B isn't. So do you hold off on company A because you'd rather get company B, if you can't do both? And so there's just a lot of, permutations on that pipeline that we have to work through. One of our both challenges but also opportunities is in our market, which is really venture capital and private equity. It's very barbell. There's like a lot of small companies in this space that carved out little niches, and then there's BlackRock and then FIS and huge conglomerates. And so for us, we actually have a pretty contained set of targets, and they're for better or for worse, they don't tend to be very huge. They tend to be smaller. So I think we'll probably have a broader, diverse set of companies that we can go after.
Well, it's helpful to get context on how you just consider capital allocation. It's something I'm trying to get a better understanding of. Just to switch things up a little bit, the execution of all this stuff. Like this has been great. We talked through strategy. How do you price the deal? Now we agree on it. But along with that, you have a team. You got a head of Corp Dev, a Corp Dev team that's helping you. Can you give me a sense? And I feel like a lot of our audience are in corporate development. That relationship, working with the CEO, what's the magic there to really make it successful?
Yeah. So I would say I'm incredibly lucky. My CFO did M&A at Salesforce. My chief strategy officer did M&A at Salesforce. Our head of Corp Dev is fantastic. I think you might be talking to him soon. So I have a very experienced team. I'm the novice here. In my team. The division of roles is pretty simple for us. My job is to convince the founder that they should make their company actionable. That is my job. Is that first step of how do we unite these visions together. The entire diligence process, the evaluation of the company, the data, the pricing, all that stuff is done by the team. And I even tell the founders, I'll say, I'm not even. I'll tell them I'm not qualified to negotiate price. Like I don't even know how this stuff is done. You should talk to the finance and corp team. Inevitably, it will eventually come to me for the final ask of how to get the deal over the line. But as much as you can, you want it to be dispassionate conversation with the Corp Dev team, and so that I can just spend time building relationships with the founders. It's a little bit like salary negotiations. It's just you're trying to convince this person that to give their baby, their life's effort to your company and work together for another 5 to maybe 10 years. You also don't want to hurt that relationship because you're nickel and diming them over, comps. So you try to separate those conversations, and my team's very good at talking to the financials. And then by the time it gets to me, in terms of closing the deal, hopefully, it really becomes that the team has done all the diligence work. They've done all the negotiations. And now this comes down to the final ask. The founder, you set the founder up to say to me, hey, I really want to come to Carta. Here's my last ask that the team can't do. Can you get this done? And then it's on me to decide if we can do that for the founder or not. And that's the best setup, right? Where I'm now the hero. I get to start the relationship off by helping the founder make their dream come true of having a successful exit.
Okay, so you're very much focused on relationship, getting things over the finish line, having and that relationship with the build a team for them to tee that up. The team executes. They ultimately work with all the moving parts in the company, plan out how this thing's going to get integrated and the employee experience for them transitioning. How would you, I guess your expectation, and maybe I just want to hear it in your words, if it's like, okay, here's head of Corp Dev that I'm working with and what I expect from them. Your CFO's involved. What do you expect from him? Is there any other stakeholders? Is the integration lead coming to you, or is it just purely with the, how do you going to make sure that transition is going to go well?
Yeah. So right now, though this may change as we're growing, Corp Dev does the deal as well as the integration. So they can't just do a deal and hand it off. They're responsible for making it work. They have a whole checklist, like a whole process. So even before the deal, our CPO, our CTO, our chief revenue officer will meet the team. Like we'll expose a lot of surface area of Carta, not just for us to understand them, but also for them to understand us. Because one of the biggest questions for the founders and the employees of the acquired company is, what's my job when I come there? Like, what do I do? And so you spend a lot of time talking about, your sales team will work for for Jeff. Your product team will work for Shale. Your engineering team will work for Will. So why don't you meet them? Make sure you're comfortable with them. So we surround them with all the executives, and so we have a whole process. The Corp Dev team will run through that entire process, and it's also just part of our board diligence, right? So when we go to the board and we present the deal, we have to tell them this is all the things we did, and this is what our CTO said, our technical diligence, our product diligence, our HR diligence, like all of the things. So this is a big company. We have to cover our bases as well. And then once it's consummated, the same team starts doing the integration plan, and they'll go and we'll do offer letters. We'll do all the project management around that. You start embedding the employees, and you slowly move the company into Carta.
They do it. You just want to be in the know. It sounds like a lot of those key elements across those departments, you at least want to know what are the big risk factors and have a good view.
That's right.
So if anybody asks you questions, you can answer them.
That's right. And I think one of the things to keep in mind when you are coordinating all these conversations is it's important to segment. So what will typically happen when you bring a new deal to an exec team is everybody will talk about what could go wrong, right? Because for us at the strategy level, we think about how great this is going to be. But if you're a VP of engineering or CTO or VP of sales, all you think about is like, am I going to lose my job over this? Right? Am I going to get all these new people that I don't like or don't do what they're told or aren't very good, and I'm going to lose my job? Like, there's only risk. And so what happens is these conversations turn into what could go wrong instead of what could go right. And it's really important when you facilitate these conversations that you orient the exec team, particularly if the CEO is not the sponsor of the deal, and you pass that sponsorship to somebody else, that people are allowed to have the what could go wrong conversation, but we also have to have the what could go right. People have to see how this could work if it works.
That's interesting to drive that as a balance, because you're right. People tend to bring up the problems. There's obviously the solutions to those problems, but then the big picture things of what we really want to achieve here.
Yeah, they have to see the vision of why we're doing it. Otherwise, for the average executive or senior leader, as a CEO, you just added more work for them. They're like, I already have a full-time job, and now I got to integrate a bunch of people I don't know. Like, why? So the thing to figure out is how to make sure that people understand what we're trying to do and are bought in.
I got another topic. I know we don't have time to do a deep dive into it, but I at least want to get your initial thoughts about international expansion. Just because something I'm really fascinated about. There's a whole aspect of the timing around it. Do you use M&A as a tool for that? I just want to hear just maybe some general thoughts of your experience and what that's been like.
Yeah, I think in general, M&A sort of fits, again, to bifurcate things. It's something you know how to do, but you're using M&A to accelerate it, or that's something you don't know how to do. So you're using M&A to learn how to do it. And I think for us in international, a lot of companies will do it inorganically, and they'll just put boots on the ground and sort of figure it out. I think we did that in Singapore. So we didn't buy
organically, right?
Organically.
Yeah,
I'm sorry, organically. Yeah. So for a lot of, so in Singapore, we went organically. If you know how to do it, you might as well do it organically. It tends to be cheaper, and you get to control it and less risky. So you go organically, and we did that in Singapore. In Europe, what we realized is there were already people there doing exactly the same thing that we wanted to do. So we didn't have first mover advantage. And two, it's just hard to do this stuff in Europe. Like, we learned it's hard to do in Singapore, but it's even harder to do in Europe because it's just Europe. It's just the regulations, the culture, the slowness of everything. And so we decided, we bought two companies, CapDesk, which was the top cap table company in Europe, and then Valbon, which was like an SP. It's like Angel List, but for Europe. And that gave us 150 people on the ground there and allowed us to get going. Both have been great acquisitions for us. Our challenge in international markets is how do you continue to support, and we're opening an office in Luxembourg, we're opening an office in Abu Dhabi, but how do you continue to support these international efforts when most of the focus is here in the U.S.? 95% of our employees are still in the U.S., 90% of our employees, 95% of our revenue. And so one of the big challenges is we have strong MDs in both regions, But how do you make them feel like they're not forgotten children and they're integrated into the rest of the company? And that's the real challenge that we've seen in international.
Is there like a right time to start expanding international?
I think most companies do it too soon. I think because it's incredibly expensive, but even more than the cost, the return on exec time is very low at the beginning. Like it takes time to build into these regions, and I used to go to Singapore, Europe, Middle East, everywhere. I think like this April, May, I think between 2 months, I was home 12 days out of 60. So you're just on the road constantly, and you're like, is this the best use of my time when 95% of our revenue is in California and New York? Shouldn't I be there? And so I think the return on time is especially for the CEOs, because the CEO is really the only person that I think can do this. Open international offices effectively. And so I think one of the, I don't know if this is the only threshold, but I would say one of the important thresholds before you go international is that you feel like the U.S. business can run pretty well on its own. Because once you start working on international, if you're going to make that successful, you're not going to be home very much.
Henry, what's the craziest thing you've seen in M&A?
I don't know that this is crazy, but I would say that what's funny to me is there would be a lot more M&A happening today if we could cross the bid-ask spread. And the problem is that a lot of founders still don't understand valuations. Like you will talk to founders that run, $500 million EV companies, valued companies, and just don't understand the basics of how to value it and multiples. And I keep telling investors and venture VCs, you can't, well, you can do whatever you want, but you complain that there's no liquidity in the market. You can't get liquidity. But then you tell all your founders that they could be Mark Zuckerberg. And so they won't sell because we give them a fair price and they go, I'm worth $1 trillion. And it's like, we can't get deals done because founders have completely misset expectations of what their companies are worth, driven by the investors that should know better, but they don't. And it's crazy to me that investors aren't talking to founders about being more rational.
That's the only thing I've seen in like 20 years in this sector is just valuation hype. And I feel like there's one aspect of just information is more accessible, but then it's just like very hyped. Like it's the big valuations that get broadcasted and hyped up, but the reasonable ones don't get talked about at all. So now all of a sudden everybody's kind of valuation fever basically, and their expectations 20x. Well, not in this market.
Yeah.
It should be a little more reasonable.
Yeah, 100%.
Henry, this has been a great conversation. I want to thank you for taking the time with me, helping me become a better M&A scientist.
No, super. Thanks, Kison. Love doing it with you.
Those of you that listened this far in the interview, I want to thank you, fellow M&A scientist. Love to hear feedback. Anything about this interview, I always welcome the criticism so I can get better at doing this. Feel free to reach out to me on LinkedIn. Until next time, here's to the deal.